We're going to move on to our next topic now, which is supply dynamics. Frank, Michael has said that as the price of gold goes higher, so does the incentive to mine and prospect it, which leads to increased supply. He has also said, quote, ultimately, you have to find something which you can't print more of that doesn't have its fundamental underpinnings tied to a fiat currency. And the only thing I can find right now is Bitcoin. So while gold can be labeled scarce, how do you defend the fact that in theory, it does not have a ceiling to supply? You have 5 minutes, Frank.
All right. Well, from listening to Michael in the past, when he talks about gold supply, it's clear to me that he doesn't have a real understanding of the gold mining industry. Just before I talk about supply, let me just clarify on demand. So about 50% of gold demand comes from jewelry, mostly from India, where it has deep cultural ties. About 20-25% comes from central banks, and they've been buying furiously over the last 10 years. And the other 20-25% comes from investment. These numbers fluctuate a bit, but they've been pretty steady over the years. So that's the demand side. On the supply side, I think Michael has made some very erroneous assumptions about gold and gold production. I've spent my entire adult life financing gold development and exploration around the world. And I can tell you, even when you find it, it's not easy to mine. The average period between discovery and production is 10 to 20 years and sometimes longer. And the grades are getting lower and lower, and it's becoming very expensive and time-consuming to find these deposits. No world-class discovery has been made in the last 30 years. All the gold discovered in the last 10 years is less than half of the amount of gold that was discovered in just 1 year in 1990, when gold was under $400 an ounce. The gold mining industry is facing an existential crisis when it comes to its reserves. They're depleting and they can't replace them. Over the last 8 years, the reserves held by major mining companies have dropped 40% over the last 8 years. And as I said, the grades are getting lower, which means you have to move a lot more debt, which raises the costs exponentially. So there is one big problem. And the truth about mine supply that's going to really help Michael here, because I don't think he really understands how price does and doesn't affect gold. In 1971, when gold was $35 an ounce, the global production of gold by mining companies was 1,500 tons. Scroll forward 50 years, gold's gone up 50-fold, 6,000%. That number has only doubled to 3,000 tons a year, which averages out to 1.5% growth per year, which is about the same you see in terms of population growth. Now, comparing it to Bitcoin, yes, Michael's right, Bitcoin's supply is capped, but there's still a supply of 3 to 4% inflation a year, which is obviously declining over a period of time. But I see a lot of risks in Bitcoin before you reach that zero inflation rate. So I see both gold and Bitcoin have inflation rates and supply, and you can argue that both supplies are declining. So I asked Michael, as the gold price continues to go up, where is all this extra gold going to come from? And I've heard you talk about asteroids, I've heard you talk about some new alchemy process, and if you seriously believe that, bring it on. But I suggest you don't go there, because that just doesn't make any sense. The fact of the matter is that for both Bitcoin and gold, it's not the newly mined supply that you need to be concerned with. It's the existing stock. And the question you need to ask is whether it sticks as the price goes up. And I've got a lot to say about that. So you got to stop saying that there's an infinite supply of gold if the gold price goes up. It's just simply not true.
Frank Giustra, thank you for that. Michael, you'll have 1 minute to rebuttal that.
I would say that there's conflict of interest between people that make their living in the gold mining business versus people that make their living or pin their hopes on gold holding. They're actually naturally enemies. And so Frank's life as a gold miner, I think, colors his view of gold. Newmont Mining and Barrick Gold are the two largest gold miners in the world I could find. I read both their annual reports to get ready for this. Newmont mined or sold 5.8 million ounces last year, and they reported 94.2 million ounces in reserves, almost 18 to 1, 18 years worth of reserves. And Barrick mined 4.76 million ounces and reported 68 million ounces in reserves. They found 10, 15, 20 years worth of reserves. They don't have an interest in reporting more, but they don't seem like they're anywhere close to running out.
Thank you, Michael. And now we'll go to your supply question. With a total limit of 21 million issuable coins, the rate of increase in available Bitcoins is not keeping pace with the number of people keen to buy them. So the price of a Bitcoin keeps increasing. Because its price increases, people feel reluctant to use them as currency by spending them. So with Bitcoin supply constrained and falling short of demand, do the supply side dynamics prevent Bitcoin from functioning as a currency?
Yeah, so my view here is Bitcoin's the ideal architecture to be a currency and gold isn't. I started my career modeling commodities, and the history of commodities is as the price goes up, the demand decreases, the supply increases. Gold is a commodity. Bitcoin is a scarcity. As the price goes up, the supply is constant. Historically, all commodity businesses, they need a cartel to be stable. John D. Rockefeller formed a cartel. OPEC is cartel. The De Beer Diamonds cartel is the same. If you look at, just about everything in the world, you have to have some kind of restraint of trade. If you can't get it legally through patents or technically through some special sauce, then you have to get it another way to make the price go up. Otherwise, the price doesn't go up. If we build a dynamic model of gold, it works like this. The price goes up. The miners increase output. Jewelry demand decreases. Scrap and jewelry get recycled at increased rates. Bankers and financiers sell more gold derivatives short, and they're more aggressive about it. Investors fund more mining development and mining expansion. Miners come online, capacity comes online, miners sell more gold. Eventually, the price goes high enough, the government stops buying gold, they start selling gold, or they short the gold, the price comes down. That's the problem with having 90 kilotons worth of gold as jewelry and so many tons of gold sitting in central banks. It's a damping feature. When the price goes up by a factor of 20, everybody on earth is trying to make the price come down, and they have a lot of tools to do it, especially because there's no quick link or tight link between paper gold and physical gold. If you look at a dynamic model of Bitcoin, the demand goes up, the price goes up, mining stocks go up, miners stop selling Bitcoin, miners start buying Bitcoin with equity and debt, which keeps going up. Investors buy Bitcoin, companies buy Bitcoin with equity and debt, like my company, which borrowed $1.7 billion at nearly zero interest to buy Bitcoin. Banks can't short the Bitcoin. Governments don't have the reserves to sell to short the Bitcoin. The government has less motive and less capability to manipulate the price down because they don't have it. They can't sell it short. The banks, the mutual funds, the insurance companies integrate and they market the Bitcoin. Big tech, eventually Apple, Google, and Facebook integrate and they market the Bitcoin. And investors buy the Bitcoin. Then they get more investors to buy the Bitcoin. The Bitcoin price goes up. The investors, the companies, and the countries buy the Bitcoin. Gold mining requires $100 billion a year in fossil fuels, labor, chemicals, and environmental damage, and the never-ending struggle to inflate the gold supply and undermine the price. It's providing zero security transport or audit service, and that would cost tens of billions more. I've watched 100 interviews by David Lynn, and I feel bad for him. He keeps waiting for gold price to go up, and he says on 3/15 of this year, he says, in a rhetorical question, musing, what if miners stopped mining gold? And he knows the answer, which is if the miners stopped mining gold, gold would be a good investment. And every gold investor knows this. Bitcoin mining requires $2 billion a year in electricity, $2 billion a year in hardware to provide full security, transport, and audit service for the entire network worldwide. It scales to hundreds of trillions of dollars of assets and annual transfers. It'll support billions of users, billions of nodes, 100 million transactions a year. And it provides the base layer for tens of billions of instant transactions per day on the application layer, i.e., Bitcoin mining is a good use of energy. Gold mining is a destructive use of energy if you're a gold holder versus a Bitcoin holder.
Thank you, Michael. Frank, you'll have 1 minute.
Okay, so again, Michael, you're ignoring what I just told you in my last segment, that the fact is that history has shown that even when the gold price goes up 50-fold, over 50 years, we've only seen a double in the amount of gold mined. So you keep ignoring that, but that's just a fact. Certainly there are, as with any commodity, including Bitcoin, there's always going to be supply when the price moves up. And you know, this concept that a higher price just drives in more buying works to a point. It sounds to me more like a bubble environment than what it's been suggested it should be as a store of value. So I'm still not buying that. You're going to have obviously jewelry scrap sold into rising prices, but as I said earlier, the jewelry demand has been steady. Year after year after year, it represents 50% of the demand for gold. And now, listen, you can't, if you're going to attack gold on environment and energy, I mean, you can't even go there. I mean, the amount of energy consumption that Bitcoin uses today is the entire population of Nigeria, 90 million people. It's estimated soon is going to be the entire energy consumption of Japan. And as far as the environment, I mean, most of that hash rate's coming out of China, where there's a lot of coal, including, it's got hydro, but a lot of coal. And there are CO2 emissions that are getting dangerously high and are going to be looked at by the environmentalists. So I don't think you want to go compare environmental damage between gold and Bitcoin, because I think you're going to lose that battle.
Thank you, Frank. We are going to move on to our